12 life-changing things you can do now. That interest rates are up again. How to profit from rising interest rates. Best investments in rising interest rate environment. Stocks that will profit from rising interest rates. Investing when interest rates are high. CD rates predictions. Projected interest rates in 5 years. Fed interest rate decision today. Stocks to buy when interest rates rise. This proactive approach ensures your money doesn't languish at low rates, maximizing your potential earnings. Shop aggressively for the highest savings yields. As rates rise, target the highest yields when saving by frequently comparing rates on savings accounts, money markets, and CDs. Online banks tend to hike interest rates fastest to attract deposits in a higher rate environment. Don't leave money languishing at low rates. Doing so can provide the added benefit of locking in financial stability and predictability, shielding you from potential future rate fluctuations. Make informed financial decisions today to reap long-term benefits. Lock in fixed rates by refinancing loans. Act now to refinance large fixed-rate loans like mortgages and student loans before rates move significantly higher. Even securing a rate just 0.5% lower will save thousands in interest expenses over the loan term. Floating rate loans can also be converted to fixed rates now to capture stability. You effectively shield yourself from the possibility of being caught off guard by unexpectedly higher payments when interest rates inevitably make a leap. Pay off all adjustable rate debts aggressively. To limit interest rate risk from Fed hikes, pay off any adjustable rate debts like credit cards, lines of credit, and ARMs as fast as possible. Eliminating variable rate products prevents being surprised by higher payments when rates jump. By staying informed about market trends and consulting financial experts, you can develop a robust strategy that ensures your financial stability in the face of changing interest rates. Prepare for payments to rise on existing ARMs. If you have an existing ARM, prepare for scheduled rate resets by budgeting for higher monthly payments phased in over time. Have plans to pay down balances before teaser rates expire to avoid payment shock, allowing you to take advantage of favorable terms. This proactive approach not only saves you money, but also strengthens bargaining power. Such preparation is essential, which could inevitably push costs higher across various sectors. Get pre-approved to lock in current rates. For major new purchases requiring financing, secure pre-approvals now to lock in comparatively lower fixed interest rates and strengthened bargaining power before further Fed rate hikes push costs higher across the board. This strategy can provide a breathing space to manage your debt effectively. By doing so, you can avoid the potential burden of high standard APRs that might kick in afterward, ensuring a smoother path to financial stability. These sectors often benefit from increased economic activity and higher interest rates, as they reflect growing demand, which can offer stability and dividends during rate fluctuations. Stay diversified across these sectors to manage risks while remaining focused on achieving your long-term financial goals. Use introductory balance transfer offers. Consider shifting high credit card balances to new cards using 0% intro balance transfer offers to pause interest for 12-18 months. Create a disciplined plan to pay down balances fully before the 0% period ends and high standard APRs kick in. In an economic landscape prone to fluctuations, their returns remain resilient. Create a diversified bond portfolio with varied maturities to balance risk. To ensure stability, focus on investment-grade funds that boast strong performance histories, reassuring investors of their reliability. Target investments that benefit from rising rates. Research sectors like financials, industrials, energy, and utilities that tend to perform well in rising rate environments. Balance them with rate-sensitive stocks like REITs and telecoms. Stay diversified and focused on long-term goals. Target investments that benefit from rising rates. The current economic landscape underscores the wisdom of making this pivotal decision sooner rather than later. Add exposure to floating rate bond funds. Floating rate bond funds and short-term bond funds provide income that rises along with Fed rate hikes. Create a diversified bond portfolio with varied maturities. Focus on investment-grade funds with strong performance histories. By doing so, you can potentially reduce the burden of high-interest credit card debt. This strategic approach enables you to channel your payments more effectively, aiming to pay down balances in full over the designated period. This financial maneuver could provide you with a clearer path to debt reduction and financial freedom. Lock in comparatively lower mortgage rates. Mortgage rates are headed higher but still attractive relative to history. Buying a home now locks in affordability compared to projected future rates. Capitalize on securing fixed mortgages under 7% while you still can, creating a secure financial haven. In this manner, I-bonds effectively hedge against inflation, offering stability particularly when liquidity isn't an immediate requirement. Consolidate credit card balances to fixed-rate loans. Consider rolling large credit card balances into fixed-rate personal loans or lines of credit products to lock in stability. Weigh loan terms carefully and focus on paying down balances in full over the period. An expert analysis considering the nuances of your unique financial situation can provide invaluable insights that empower informed decisions. Purchase I-bonds, paying inflation-adjusted interest. I-bonds are government-guaranteed securities paying interest rates reflecting inflation. Rates change twice yearly, but lock in for the holding period. I-bonds hedge inflation and provide stability when cash isn't needed in the short term. This strategic approach is crucial because interest rate fluctuations can significantly impact various sectors, including housing markets, investments, and consumer spending. Regularly monitoring expert opinions and data-driven insights empowers you to adapt your financial strategies, optimizing your decisions for potential changes in borrowing costs or investment returns. By understanding the intricate connections between monetary policy shifts and broader economic trends, you position yourself to capitalize on opportunities and mitigate risks in an ever-changing financial landscape. Review your whole plan with a fee-only financial planner. Schedule a consultation with a fee-only financial planner to review your whole financial plan and make personalized recommendations on how to respond and optimize in the rising rate environment. An expert analysis is invaluable. Closely follow Fed announcements, economic analyses, and interest rate projections to stay continually updated on where rates are headed. Being informed on the outlook allows you to make proactive financial moves early, as conditions change. Avoid reactionary moves by focusing on long-term financial health and security. With prudent adjustments, fiscal discipline, and maintaining perspective, your financial life can flourish well into the future despite rising rates. Conclusion. With strategic foresight, expert guidance, and timely action steps, you can prosper in the new world of higher interest rates. Whether it's maximizing savings yields, locking in fixed-rate stability, opportunities through astute investments, you possess the inherent power to steer your financial future. Navigating through these dynamic changes might seem challenging, but remember that history is filled with instances of individuals who thrived by embracing change. So grasp these tips with determination, for rising interest rates need not be a hindrance. Instead, view them as a chance to further accelerate your journey toward enduring financial success. Or capitalizing through targeted investments, you have the power to master your money future. Implement these tips and rising rates don't have to slow your financial success.